Hey everybody, Jonathan Broadbent here. Welcome to UnWoke.Academy. I have a longtime internet friend, Victor Ricciardi, is on with us to talk about behavioral finance. And boy, am I delighted to dive into this. I'm going to preface it with the comment that through my career in finance, I've stayed sort of at least marginally aware of the world of behavioral finance, which we're going to dive into a little bit today, and its impact on kind of financial institutions, how they operate, what they do, the decisions they make, the marketing, all of that stuff behind the scenes. And here's sort of my, I won't say layperson because I'm a little bit more advanced than layperson, but my non-specialist perspective on behavioral finance. I believe that most of these major financial institutions put a lot of faith, time, money, thought, and energy into behavioral finance. So people like Victor are fundamental to a lot of business development for financial firms. One piece, not to put too fine a point on this, but there was one instance, and I've mentioned this before in a couple of different podcasts because to me it's kind of like a discovery moment. There was a firm I did some work with years ago that put together a postcard mailing program tied together with a web-based experience. And they found that that was really successful, and they retooled and tweaked that little sort of marketing niche based on postcards. I discovered that that firm spent over $100 million just on that postcard campaign, developing it and getting the maximum possible reaction out of people. So hopefully that factors into our discussion today. But Victor, can you tell us more about your background, behavioral finance, and your view of those types of things that financial firms do?
Sure. I'm currently, well, first thing I like to plug is my current book, an advanced introduction to behavioral finance. I actually sent you I felt very humble that I actually sent you requested a signed autograph, so that's not a problem. It will be worth millions of dollars and millions of years with that signature, I bet. But so I have actually three books in the area. The current book has a paperback, and it's a good introductory. It's around $25. It's even a little bit cheaper if you get the electronic version. So it's nice to have something. My other books are a little expensive for the average reader, so it's nice just to have something that's about 150 pages that's accessible to a wider crowd. I started off as a portfolio account in mutual funds. I thought I was rational. In the 1990s. Then I lived through the internet bubble. I lived through the financial crisis, and I lived through we all lived through the pandemic. So essentially, I got religion in finance, and I've been a professor full time for about I would say for nearly 20 years. I've taught part time for at least 5 years before that. So currently, I'm at Science College in the Philadelphia, right outside the Philadelphia area. I'm visiting, and I just love teaching, and I love doing the research in behavioral finance. I love it. I love. I enjoy sharing my knowledge, but also ultimately I do this because I'm trying to educate, change people's behavior, provide a little bit of personal finance, so we make better decisions. As a society, these decisions, whether we want, we can look at government for answers, but at the end of the day, these decisions are really up to us, and how active we are will determine our standard of living, the proper health insurance, the proper savings. Yeah. As I tell my students, I'm teaching a financial planning course this semester. It's needs versus wants. I know people make $200,000 and all they do is make decisions based on their wants, and they're always broke. I know people who make $50,000 who make decisions based on their needs, and they have more money than the person making $200,000. So it's all relevant. It's how we make, what's important to us. We don't have to starve ourselves with money like a diet, but it is important to make choices, and financial decisions are tough. It's not always going to be fun unless you're extremely wealthy. So for the vast majority of us, it's like going to the doctor. You're going to have to take some tough medicine at times to ensure that you're going to have good health.
Good analogy. Actually, I often use the analogy of like our diet.
Yes.
And so there's an expression that I use. I've sort of thought this way for many decades now, that there is no such thing as unhealthy food. There's an unhealthy diet. So when it comes to how we manage our financial lives, I think that you're definitely onto something. And I think that's something that most people, even people who are currently caught in a rut and maybe making decisions that aren't leading to a more successful financial future, can at least get their heads around. And that is maybe some tweaks and changes here and there, and introducing more healthy behaviors in my financial patterns can bear fruit.
Yeah, and also I didn't really I had forgotten to comment a little bit on what you said about firms using behavioral finance, and I think that's to an extent a good thing, but I worry about manipulation as well. So
Yep.
I'm not going to say which brokerage houses, but even like the idea of they have this area of nudging to help people make better decisions. The problem is, I worry, for example, casino behavior in which, bells, whistles, people make money in the casino. Now you have online platforms that use that. And so what I worry about is taking some of the wonderful aspects of behavioral finance and associating like gambling type of stuff with investor behavior. And then it's really not investing. It becomes trading and speculation. So there's a very fine line. I've done a lot of consulting work myself at various firms, but I really try to tend that. I really am like a person who tries. I'm like the party pooper at the party. I try to take care of the individual investor. I have no agenda. I don't manage assets for anybody. I maybe do some speaking engagements here and there. The books I don't really make that much money on. I do it for the passion of educating people. And so, and I'm not always saying I'm right, but I'll at least try to give you what I feel is an honest opinion that's unfiltered, and that's not going to have a conflict of interest.
Excellent. So I'm going to interject a point from my audience. My audience tends to lean right, more conservative. We actually had a conversation in the lead up to this discussion. Really, everything we're talking about today has no particular bearing, conservative, liberal. It could be anybody on anywhere in the sort of political spectrum, if you will, right or left, should have an interest in behavioral finance, because everybody should desire a stronger, more solid foundation for their financial future. Now, my thoughts tend to be, as I read this, and I'm just going to make the comment that I read a lot of trade publications, and thank you again for my signed copy. I love it. I read a lot of trade publications and discussions. I get online things. I do webinars and seminars and all those sorts of things. And a lot of that really falls in the category for me of, it's like fast food burgers. If I'm going to call those fast food burgers, this thing, Victor, this is steak. This is a steak dinner. This thing's spectacular. I mean, just the research and the citations and everything, it's awesome. Thank you for the detail you put into this.
My two colleagues, Ken Baker and John Nofsinger, who are co-authors on this, are phenomenal. I mean, I've done two other books with Ken Baker, and I humbly admit I would have never finished 3 books without Kent. He's done 45 books. So the people that we associate ourselves make us better. And even from the way I look at behavioral finances, so I know even there's this debate, it became a political debate about social investing. Myself, I tend to be more on the business side of things. So I may not necessarily be a fan or have some, I don't want to say doubts. I have at least a little bit of concern about social investing and the governance issues, but I think it shouldn't be mandated by government. It should be given up to the choice of the investor. And that's why I work with people who are both liberal and conservative or in the middle. And I see if someone's more liberal, that if you offer and I've worked in a number of different places, but at least if you offer a couple of different social funds in a group or a 401k, a 403b plan, equivalent of a 401k plan, those people who have more of a liberal background and who are more skeptical of the stock market, they're more open to at least saving money in the market because you are offering them social funds. You could debate about the agenda. It's just that them understanding maybe their portfolio may not be as diversified. Maybe they need to save more money. Maybe they're going to be more, choosing more conservative investments because if you remove things like energy stocks and things like that. Myself, I will invest in energy stocks because I don't look at that investing in the energy stocks necessarily to make money. I'm using them to make a hedge against inflation to maintain my standard of living. And the other thing that I tell people is if you're investing in things that you don't think are social investments, then if you have too much money when you die, leave it to charity and God will be very appreciative of it. So there are different ways of framing the conversation. And it's really up to the individual. So I would agree that we've got way too much with not worry about the individual, but the choices should be given. It's just I don't think it should be heaven. I agree with the idea that it shouldn't necessarily be heavenly mandated. It should be provided, and that's the thing with the nudging. So, for example, automatically putting people into retirement accounts now. In the past, they found that even though people offer like a 401k plan at work, maybe 30% or so of people would not participate because they suffer from inertia. And so instead, rather than voluntarily contribute, they automatically put people in. So that's known as nudging. The problem is that they don't provide any investor education, and they additionally, there's no meeting with a financial planner. So I was talking to my students about this week. So, for example, they have most 20-year-olds, if they have $2,000 in a 401k plan and they never took a finance course, they're going to withdraw when they switch jobs and they see $2,000 in an account and they're only 23 years old. They're going to withdraw that money because they don't understand the value of time value of money. So it's a good first step, the idea of nudging, but it's not, as we said, it's not treating the entire patient.
So this is an unexpected turn. I'm going to throw a few things out into our conversation that you actually may not know, but you've sort of landed in my wheelhouse. So some years ago, I got to know Shlomo Benartzi and Fred Barstein pretty well through that's Los Angeles Unified or Los Angeles Anderson School of Business, I think. And he also, or they also, I should say, are very focused on exactly what you describe and the idea of nudge and those sorts of things in 401k plans. But a few things that occur to me all at once. One is, and I'd like to get your feedback on two things kind of simultaneously. I'll give them one at a time. Some years ago, it was actually led to some conversations with Fred Barstein, who now runs the Retirement Advisor University in Southern California. But there was an idea that I had and actually went for patent to create an incentive rewards program inside of 403b and 401k types of plans. For anybody not familiar with the first term, 403b is kind of a cousin to 401k. They're very similar. Those are retirement plans that tend to be more colleges, universities, hospitals, and nonprofits, but very similar. But the point is to try to continue working on tweaking things that make it desirable and attractive for people to invest. I'm going to pause there and ask for your feedback or your thoughts on what you're seeing in the marketplace and in discussions in academia about continuing to nudge people in that right direction.
Yeah, and that's where you have to be very careful, because then you're worried about an overreach of, you know, are people being manipulated. I mean, so that's the thing. Even the idea, okay, so so for example, it's a good thing that they now put a disclosure on credit cards to provide how much interest the person is definitely paying. So that indirectly maybe comes out of nudge. The other thing that I worry about, though, is, for example, if you have a bank or financial institution offering a bank and then having incentive, say it's an extra $100, it's given a raffle, and they may win an extra $1,000 cash. There you're crossing the savings issue with the gambling behavior. And so I don't know how we have, so you want to have incentives, but you don't want to, you really want to have a strict firewall between investing and gambling and trading behavior. The same way we still have at least a degree of a firewall, the understanding between, we have a FDIC insurance for banks. So the banks are still banks, and a brokerage account is still a brokerage account, to agree that losses are not insured on your principal. And so we have to be very careful when we are doing these things to, what sounds like a good idea, and if there's not enough thought or research to back it up, I can even see in the classroom now. And this is only one study, but there was a recent study that I saw, and I didn't get to read the whole thing, but for example, someone had found that students reading from a physical textbook versus an online font learn better from the paper textbook. So we make these changes, whether in academia or what we think are good business practices, but we really don't have the data. And so that's why I'm more data driven. I think that if we have the data, if we have enough, if there are enough issues going on, also we don't pilot, even when you start government programs, you don't pilot study things. We just go in, we should do more experiments, if you want to call them, or pilot studies before making these big changes, whether financial commitments to government programs or making changes to put into allowing certain types of changes to 401k plans and so forth. I mean, even if you look at 401k plans, you can my students, I try to crazy because I talk so much about mutual funds, and I try to tell them that mutual funds are the most regulated, one of the most regulated items, but they're all typically only thing offered in 401 and 403 plans. If you buy a life insurance policy with a cash value, it's usually only a choice of mutual funds. So we're very slow to move on certain things, and I think we move too quickly on other things.
So that's a good segue into sort of one of the basic tenets, as I understand it, of behavioral finance, and that is what I'll just generally loosely refer to as greed versus fear. And it seems to me, in the studies that I'm aware of, fear overwhelmingly overpowers any sort of hope or I shouldn't say greed, but ambition maybe is more the word that I'm looking for. And it seems in the world of finance, if we are looking for manipulations and the machinations of financial firms that are trying to extract behavior, it seems there is certainly a lot of talk about hope. And a lot of commercials seem hopeful, but a lot of what's sort of driven in messaging is fear focused. And at what point is that become easily manipulative? And how much of that are you seeing? And how much do you see from people like you who work in that marketplace pushing back against that fear-driven narrative to manipulate people?
Well, and that's where the conversation again. I think it's not just a behavioral issue; it's thinking about, how does an advisor, but also how a client is being taught or communicated to. It's not just the behavioral issues. It's being able to communicate to somebody if they don't have financial literacy, telling them why they're making financial advice or financial issues are being recommended. Having a diversified portfolio, explaining to somebody that actually putting your money in something when it's not the hot dot is trying to get enough diversification and not having the same correlation of assets. And so coming back, so I guess I don't think it's really a manipulation. It's having people understand we, as human beings, we are primed to we want to buy low, sell high. The problem though is when we have fear, we sell at the worst time, which is low, and on greed, we buy high. So if you really want to just correct the behavior, we have to either institute a non-emotional strategy in which you do the opposite, or be aware of what the opposite is. When the market goes down, if you're a long-term investor, it's a buying opportunity. You're getting more shares at a cheaper price. When the market's going up, you have extended runs way above your historical average in every historical asset class. I tell my students, you don't trade, but you take money off the table. Even if you just do something like risk tolerance. Let's say somebody's an average risk taker and they have an asset allocation of 60% stocks and 40% bonds. I control the fear and the greed act. If the greed goes up and at the end of the year you're 70% stocks and 30% bonds, use rebalancing and sell and reallocate, and then go back with your risk tolerance to your non-emotional plan. Because again, if the market's going up, we want to keep on let it ride. Well, take, like at the casino. That's where the casino does matter. Take some money off the table rather than the portfolio. So the portfolio goes from 60 miles an hour to 70 miles per hour. Tap on the brake and then reallocate the other to the more boring bonds. And then the opposite is when the market's going down and bonds are doing better, sell some of the bond portfolio and force yourself to buy stocks when the price is lower. And so the tool, even on most 401k plans for companies, there is asset allocation available, there's rebalancing tools available, but probably only 10% or 20% people actually in the plan use it. So if you figure 50% of American public has money in individual stocks, you then have to look at that segment. How many of them are actually making good investment decisions? If something called a Delbar study that shows that the average, year in year out, maybe the average equity mutual fund investor makes about 5.5% to 6% a year, depending on 10 or 20 years worth of rolling data. And they get it out of funds. There's no patience. They don't have diversified portfolios. They chase the hottest stocks. So the problem is if we just can educate enough people on the basics and actually help them understand their behavioral issues and implement that strategy. See a financial advisor, use risk tolerance with asset allocation, proper diversification, maybe even the Morningstar box, but the rebalancing. That's how time value money combined within a financial plan with financial goals that are short, intermediate, and long term. That's how you cure the patient. There isn't like a magical cure for this. So my last point is we can just get people to do the basics and to stick with those basics and not be impacted by the biases with proper education and with counseling from a planner or advisor. But then that's the answer. I mean, this is not easy. It's the same thing as going to a medical doctor. Over your lifetime, you're going to have medical issues. Financial decisions, investment decisions, you have to be engaged, but you don't want to overcomplicate them. But you have to have, as you go through your life cycle, you have to add proper insurance and other things like that as well.
I'm going to bring up something that I've floated a few times, started in conversations with peers in the world of finance. And this is admittedly a controversial viewpoint, but one that's worth exploring and discussing. And that is the idea that perhaps we as a people, we as investors, have given away too much of our control and too much of the trust in financial systems and processes. By that I mean, and it's sort of appropriate that my mobile phone starts ringing. I have a smartphone, and on my smartphone and any consumer pretty much anywhere in the world can do, I can put an app and I can do trading for cheap. I can open up an account, and in the middle of dinner, at any time, day or night, I can start tapping buttons and I can trade things virtually effectively all over the world. And it seems really inexpensive at $5 a trade or $7 a trade or something. And sort of connected to that, years ago, we put a lot of faith and confidence and perhaps undue amount of trust into things like mutual funds, what I generally refer to as pooled investments. But when we think back to our parents and grandparents, they had stock portfolios and they actually knew what they had and they knew what they owned. Part of that goes to my discussion about woke versus unwoke and knowing what you own and feeling that whatever's in your portfolio fits your value system. But part of that also goes to who is making the decisions and to whom are those decisions visible. So if you have a portfolio of a bunch of different mutual funds, it can be very difficult to determine what it is that you actually own. On top of that, most mutual funds have some sort of management fee that you're paying on an ongoing basis. So, Victor, I've made the argument many times that more people should be migrating back toward stock portfolios, stock and bond, knowing what you own. Well, stock, bond, alternative investments, precious metals, whatever it is that you want to own, but applying all the things that you've said, Victor, having a diverse portfolio that's well balanced, and every once in a while you conduct a review to make sure that one thing isn't disproportionate and sell a little bit in small increments when it's high and then buy more of other things and low and keep that balanced. But do you agree that there should be more discussion among folks like us and the general consumer, the general investor, about the composition of their portfolio and maybe going back to what our parents and grandparents did, stock and bond portfolios?
Well, and again, that's where I think it's who you're talking to. And this is where I even yesterday, just by coincidence, I was talking to my students about what I call, you have two sets of investors, and this can be broken up a little further, but there's really financial personalities and non-financial personalities, meaning there are people who are going to enjoy investing. They're going to be quant people. Maybe they don't need to be in finance. They could be numbers people. They could be objective. And they're going to more likely have an interest in this material. But I have three nieces who are all in their 20s. Their uncle has been trying to talk to finance about them and money since they're little. They are not interested. So they are the non-financial personalities. So we still have to figure out within financial services to make sure you engage those people properly. And this is where those non-financial personalities is you can't go so much into the details. They're not going to be interested in the talking about beta or standard deviation and the quant stuff. And that's why even when I train advisors, those conversations with the non-financial personality should be 80% subjective and maybe 20% objective with less jargon, and it's really an art, but it's also a form of storytelling. Rather than communicate to those people with the quant stuff, you need to tell stories about individual clients. And so, as I said, it's also salesmanship. And again, but even myself, once you start to work full time, but also if you work in the financial industry, owning individual stocks can be a headache depending on compliance. I worked for 2 firms that drove me crazy because I worked in mutual funds, and they wouldn't even allow. I had to get legal's permission to buy and sell stocks if they were coming through the portfolio. So they worried about insider trading. And if you want to get enough diversification within a portfolio of stocks, I would say minimum you have to have at least 50 stocks, and I'm saying that loosely, and that's even a lot to manage for the average person. And I don't think there is a segment of people who do, who are high net worth individuals. They're engaged, and they're do yourself investors, so those people I think you can do that with. But there's a vast majority of people that don't have the knowledge, that don't have the time, and that don't have the interest. Mistake with the 401k plan is the idea that you didn't allow more of a ability of financial advisors to set portfolios when a person's hired. The idea that all these hundreds of millions of people who are investing in 401k plans are going to be able to do asset allocation within their portfolio, to me, is preposterous. I think the 401k plan is a decent vehicle. I have probably 90% of my wealth in it because I like saving money on taxes on the traditional 401k plan. Fortunate enough, I can max it out at this stage of my career. So I see the advantages of that. But it's, again, even when people are investing in those types of vehicles, that's why you're talking about individual stocks. You give people a choice of more than 20 mutual funds, and they're overwhelmed. It's like going to a restaurant. They can't. The more choices you give people who are the non-financial personalities, the more they don't make decisions. So that's why I think there is a place for individual stocks for the people who want to do individual stocks or pay an advisor to do individual stocks. But the vast amount of people can't even handle the choice of mutual funds, let alone if you think they're going to be able to invest in individual stocks. Based on my experience, teaching every level of college, dealing with all types of planners, speaking to at least over 100, at least to 80 groups over the years. I think that's a bit of a. That just adds to the problem. It has to be more simpler. So even using ETFs, but there has to be something that we're not doing correctly. So even now, there's about 20 states or so that are requiring a personal finance class K through 12. The problem is who's going to fund them and who's going to teach them. I'm a professor. I'm not allowed to teach K through 12 because I've never taken an education class in my life. So the people who are teaching the personal finance classes at the K through 12 level and even now are scientists, economists, if there's any on board or higher, but historians. So even when you're going to have access to more students at the lower levels, it's not even going to be finance professors. So that's a problem in itself.
So I've actually taught some of those courses in
Okay.
K through 12, basic financial courses,
Yeah.
financial literacy. So
Yeah.
how about, it seems to me there is kind of a hybrid answer if we do continue to explore that. And for my audience, I encourage everybody to consider what it looks like. And we've talked a number of times at UnWoke.academy about adding something called self-directed brokerage window or self-directed brokerage account inside a 401k plan so that you can buy and sell individual stocks and securities. By the way, side note, if you have any difficulty adding that at your place of work, contact me. We have some steps that we can help open that that avenue of investment. It's an additional alternative to the usual mutual fund menu. But once that's there, Victor, there are, for individual investment accounts like IRAs and stock investment accounts, there are two readily available options, or actually they're kind of the same. One is simply working with a broker, like our parents or grandparents might have done, and the other are people that manage something called SMA, or separately managed accounts. And those are people, it kind of looks and feels very much like a mutual fund, but it's an individual or a team of people that you actually have contact with that are making those choices about what's in your portfolio and when to buy and how much and that sort of thing. Any thoughts on that?
Oh, I mean, if you're going to do self-directed brokerage account, it's making sure, because I've been on retirement committees myself, and I can see that, especially the committees I've been on, even if I wasn't a voting member, they tend to be very, I guess, because they're fiduciaries, they tend to be very risk conservative. So they all ask what the peer group is doing, which is another problem itself. But the only concern that I worry about, and this is where the behavioral finance stuff comes in, if people do not have the proper financial education, and they exhibit, especially as males, we exhibit high levels of overconfidence, people are also going to be left open to trading too much. And so I worry that, I agree with the idea of free markets, but sometimes when people are left open to their own devices, there's going to be problems. But also, at the end of the day, if people want to have self-inflicted wounds on their own portfolio, that's one thing. I worry if we open up too much, if we open the box too quickly, and again, not thinking about stuff, that we can bail these people out. So that's my concern. Because even if people get mutual funds now, the basic data shows that at least if they're holding in a 401k plan, the fees are typically much lower than holding an IRA, because the fiduciaries of those plans are obligated to keep decent performers at low cost. So in a way, and I honestly, because I am a gambler, my father was a gambler, my grandfather was a gambler. My grandfather exposed me to the stock market. All he invested was in penny stocks. My father encouraged me to invest in the market when I was 12 years old, but he was a gambler. He was very good at cards, but also if he got a stock tip, he was ready to put all his money in. So there's a issue with my bias. As I see, that's what the behavioral research, I understand my weaknesses. So I like keeping my 401k plans I like my accounts in the 403b plans with the mutual funds, and it prevents me from trading. And so if I want to trade, I'll take 3 to 5% of my total wealth. And I used to even do that. Now I tell my students, what I started to do before the pandemic, I would take $100 and I would go to track, and I would spend a portfolio approach. I spend $10 a race, lose every race, have a couple of beers, and I got the gambling behavior out of my system. And then I was still using a portfolio of rationality, because at the end of the day, I still believe in paying people for their time. I think you look at management fees. You can, but even like when they advertise zero commissions, it's not zero commissions. It's that you're not feeling the pain of the commission. It's that they have order flow. They're charging you a commission the same way, and all that comes from is the idea of, if you buy a bond on the corporate bond in the secondary market, you buy it through the broker. They never tell you what they actually paid for it. They give you the price, and they're making a price on difference. So to me, under the current system of what they call no commissions, is less transparency. So it's I think it's really just I think it's just trying to communicate to the average person, these are your choices, why you should draw back advantages of why you should do them. If you're not going to really be engaged and really be interested, I still think the mutual funds are the better route to go. The people who are truly going to meet with an advisor, who have an interest, who have all those financial personalities, I have no problem with them directing um, their own accounts. But at the end of the day, assuming behavioral finance is right, you're going to have a segment of the population that's going to do damage to themselves. The same idea is, people started trading more with stocks with the internet in the 1990s because they had exposure to the internet. And so I was teaching students at that time, trying to tell them about the basics of stock valuation. They looked at me like I had two heads and talking about dividends. Then in later years, I'm dealing with behavior of Bitcoin and cryptocurrency, and now they could, as you said, with a phone, they could gamble with a phone. So now I have 3 situations of gambling behavior. So it's really trying to give them the other side of the argument. It's not always an easy task. I keep on pushing the boulder up the hill, and it's getting heavier and heavier. It's becoming a mountain.
So it seems to me there's an element in your description, and you and I stand out as unique in this conversation, in that we both work in finance and we understand the ins and outs of financial markets and the world of investment management, how to build portfolios, et cetera. And so perhaps there's an argument that, just like doctors not being their own doctor, maybe it makes sense for people like you and I to look to other financial professionals, because we're creating that buffer and we're eliminating any sort of bias or emotional input that we might have. And we are, hopefully, if we do a good job at it, we're finding somebody who inserts objectivity into our financial lives. And toward that end, I think really any of those can fit the bill. A mutual fund is certainly removed. A broker, somebody managing a separately managed account, that, as I said before, for my audience, that is kind of like a mutual fund, but it's more transparent. You can see what you're getting, et cetera, which fits more in line with what we talk about at UnWoke, which is knowing what you own. And there's another piece that I'd like your feedback on, Victor. And then, unfortunately, I think we're going to run out of time in this one, but who knows? Maybe we can get back on this has been a delightful conversation. I hope you think
but
so.
I mean, actually, we really haven't talked much about behavioral finance, so we can really, if we have maybe we can do another broadcast and just send me a set of questions, and we can hash out more of a detailed outline of just behavioral finance. Because the questions, I'd be glad to do another episode.
I'll take you up on that. That sounds terrific. For this one, for an introductory conversation, I'm thankful that you were willing and able to join me for just sort of a sort of see where the conversation takes us. And speaking of which, you brought up something that is key to me, and maybe as a closing thought, you can at least begin to sort of address this, and that's stock valuation. And so forever in the world of finance and in markets, we've had fundamentals, and the fundamentals dictate stock valuation. Then over time, as we've gotten into sort of individual quick trade investing on your smartphone and everything, a lot of emotion has flooded into the markets and made them very irrational. And so we're trying to grapple with that. But then now we have a new element that's perhaps even more daunting and disruptive even than all of the emotion now in financial markets. And that's the whole ESG thing. And that is the willingness, intention, and the control mechanism to use things like corporate equity index to manipulate the behaviors of companies and the resulting impact on stock price. So now we've got a completely different world for investing than fundamentals used to dictate. And for my audience, I'll come back to describing what I mean by that. I think Victor, hopefully follow my question. What are your thoughts?
Well, I would say that the first thing is, it's trying to get people, and that's why, that's why it's not, and that's why it's just not behavioral. Like you alluded to, the idea is that, you know, um, boring stocks, dividend-paying stocks are considered boring. So up to around 2 years ago, we had 10 years of growth and value stocks, which are cash flow or out of favor, didn't do anything. And now they've been doing somewhat better, but it's also getting people to understand that the years does not mean the next 10 years are going to be the same in the stock market. So that's why having a diversified portfolio is so important. And that's why trying to force yourself to put money into things that are against. So as I've gotten older, as Mr. Wonderful says on Shark Tank, I love cash flow. So I like putting my money in dividend stocks as I get closer to retirement, maybe in 15 years. But I still realize the value of putting money in growth. The thing, though, is I realize the valuation of growth, and it's different. If you're talking about growth companies that are actually making cash flow, that's a wonderful thing. The other set of companies that are not making money are very hard to value. And as I said also, so back to the ESG, I don't know how much it still impacts corporate behavior. I mean, there are some real proponents of it, but then there are like all these papers that I read about greenwashing, which is the idea of I would say in a way, companies are accused of just having 100 products, one or two products, or say environmentally conscious, and that's called greenwashing. Like window dressing. So I don't really have, and I really don't have I mean, it's talked about, but like anything else, are they actually doing it? Europe is much more into that. Still have a degree of skepticism of, okay, we have social investing, but they're still going, and that's where, if you are talking about stepping outside the 401k plan, I am definitely a proponent of you. It doesn't have to be self-directed to me. Is okay, get the tax benefits of a 401k plan with the matching and the tax savings, but also having an individual IRA. So, for example, many of my 401k plan or 403b plans don't have a choice of energy stocks, sector stocks, or enough dividend stocks. So that's where in a way, I don't want to say I'm hedging against the ESG choice, but the lack of choice, whether it's related, because it is ESG in your 401k plan or just because they're doing the style box. That's where back to where I agree with you on the investor choice. That's where you build out other issues in your portfolio that have opposite correlation. So, because your average indexes are still going to have energy stocks in them. So there may be a degree of ESG in any part of your portfolio, but I don't know how much of a worry it is. I don't. My bias is not to look at that. I'm looking at so for example, back to goals. Let's say a person wants to have $2 million for retirement, and they know they need an average return of 8% a year. If you're getting your 8% or more, I can sleep very well at night if some of my money is in ESG companies versus both my grandmothers died of lung cancer. Am I a fan of tobacco stocks? No. But if the tobacco stock is held with an index of a mutual fund and it's 1% of my 1% of an investment within the mutual fund, I don't know. Life's too short. I just can't worry about it. Yeah. I mean, we have all these issues. I look at all these other issues that are so daunting. My thing is just to get enough people to invest properly and be, I guess I don't want people not to invest because they're worried about certain things going on in the market as well. So, I mean, I think if we don't have the proper data and we don't know the true impact of something, I think we don't necessarily have to worry about it so much. Is my response.
Thank you for that. So I think For our conversation and for a future episode, I think I'm going to spend a little bit more time delineating between socially responsible investing, which has been around for a long time and is actually a great thing for really anybody in any position. It allows you to pick and choose what you might like or dislike, or you can just ignore it completely and allow the investment managers to go where they feel is most appropriate, versus ESG. I do think that there are some exceptionally harmful and manipulative tools built into ESG that have nothing to do with, to use your example, fossil fuels or green energy or whatever. They are way beyond that, and they're harmful and manipulative tools. Those are the things ultimately that in my discussions around unwoke.academy that we seek to kind of flesh out and either avoid or at a minimum expose. But I think
Yeah.
a big part of that, it sounds like you wanted to say something else.
Well, yeah, I mean, but also how you even define ESG investing and social investing is very subjective. And so if you put aside the political aspect of it, my concern is if you have a very rigid portfolio that's social investing or ESG, you're going to lead to, it's going to suffer from essentially what's a familiarity bias and under diversification. So, you may want to take this individual stand, using social investing. My concern at the end of the day, you can debate the political aspect at the macro level. My concern is making sure it's not going to harm the returns of the individual investor and prevent them from reaching their financial goals. So that's why we get into this, and that's what I was trying to allude to. We get into this argument where it becomes a political discussion about the company and but it's still investing. How do we still come back and focus on the individual? Because at the end of the day, that's the person I worry about, because I want them to have enough money in retirement. I don't want them eating dog food. I mean, those are the things. Those are my biases. Is caring about the woman who lives longer than the man and making sure she has enough money outside of Social Security to make sure she's going to be able to take care of herself if her husband has passed prior to that.
Victor, this has been a terrific conversation. I do hope that we have another opportunity to get together for a continued chat. Thank you again for joining me. This has been another episode of UnWoke.academy. UnWoke.academy. Easy for me to say. This has been Jonathan Broadbent and Victor Ricciardi talking about the behavioral finance. Thanks for joining us.